Aditya, good morning. Thank you for joining us. I'm using, I don't know whether it's a new terminology, but I'm using this terminology called blue chip fatigue. For the first time, I'm using this blue chip fatigue. HDFC, Kotak, Asian Paints, everything which is considered to be the bluest of the blue chip is now underperforming.
Well, I think the good thing with semi-bear markets is that it gives you an opportunity to do such stuff, whether it is more detailed research or whether it is come up with terms like this. So I think that's one of the charms of the market, that a lot happens, a lot cannot be taken as a given, which I think was the case with a lot of these blue chips, which is where there is a little bit of a shell shock that is happening in terms of the market response. But I just think that from a longer term perspective, if you look at cycles and if you look at stocks, this tends to happen. It is not necessarily so unique. It's just that we've not seen it for a long time because we've had basically a difficult economy. That when it actually happens, it sends the kind of reverberations that it is. But no, I don't think this is unthinkable. I don't think this is necessarily very bad in the overall scheme of things. But there is a certain amount of pain that you see at this point in time, both in confidence and in terms of the index level. So, it's nice to have new terms. It makes the market more interesting. But I don't think this would have been an unthinkable situation in the longer scheme of things of the markets and some of these stocks.
So what are you telling your clients? Think long term. This is a time to buy. Typically, we all know that the best time to buy is when there is a sale, whether it's a Flipkart sale, Amazon sale, or maybe some other sale. Is it a time to use the sale to your advantage?
The worry with sales is particularly with Flipkarts and Amazons that they keep coming every 2 months. So you don't want that happening and you going in recommending a strong sale buying kind of situation. No, but looking at it more seriously, I think a couple of things. One, it is providing you a certain opportunity with a certain set of businesses that are fundamentally very good. And quite honestly, even though they've disappointed in terms of market expectations, the results have not necessarily been very poor. So I think that's one part. To that extent, it is a little interesting and exciting in terms of looking at getting into these stocks. But I think the second thing is that I think one of the things that's happened with our market is that it's actually been oblivious to some of the challenges in the underlying economy. Whether it is the relative softness of demand that you're seeing in the domestic economy, whether it is the macro pressures that you're seeing in terms of inflation, the risks of rates rising, that, it's not as if the markets are down and they've gone lower and this is an opportune time to necessarily buy them. The markets have tended to be a little overvalued. The underlying, domestic economy and the global framework has tended to deteriorate over the last couple of months. So in that context, I think for some of these stocks, it is a decent time to buy. But I would also tend to believe that I think the near to medium term, it is going to remain shaky, the market environment. So will these stocks necessarily run away in the near term if you don't buy them now? I don't think so. Is it something that you should look at from a longer term perspective for riding out the nearer term challenges? Yes.
Aditya, I must say that I haven't seen you grin and smile so much as you did to Nikunj's bluest of the blue chips.
You like that terminology. You like that terminology of blue cap fatigue. Blue chip stocks are never supposed to go down. That is what everybody tells us. But when they go down, we say, okay. Blue chip stocks by definition are always supposed to make money, right, Aditya?
Yeah, but never say never. It can be a James Bond movie or it can be the markets, but never say never.
Yeah, but James Bond movie has also one title, which says that
tomorrow never dies.
Tomorrow never dies, which is blue chip stocks will never die.
And that is to some extent, I wouldn't say blue chip stocks will never die, but I think the reality also is that it's darkest before dawn in many ways.
Very simple. If you bought into a Kotak Mahindra Bank or a HDFC Bank, which have got everything going for themselves, their numbers are strong, their technology is the best, their fee-based income is the strongest, you've not made money in this bull market. Beat it.
But it comes back to the simple thing that we all talk about in markets, valuations. When valuations run very aggressively, then if there is either an hiccup with some of their businesses or in the economic surrounding, then you have these periods of either a lack of performance, which we've seen in the past, and sharpish absolute performance, which you're seeing now. But I just think that at the end of the day, the reality that valuations do matter to the extent of returns that you make, I think that is just being reiterated. Stock markets and making money in the markets is not as simple as it's been for one part of the market over the last couple of years. And I think that is just leveling out. It's just normalizing. And so there is a perceived element of pain.
A foreseeable level of pain that we are witnessing. But Aditya Narain, good morning. What you're seeing is not normalization when you at least look at the kind of hammering that we're seeing in a couple of stocks, right? Whether it's the HDFC twins or what happened with Infosys earlier this week, the kind of FI sell-off higher than the greater financial crisis.
Yeah, so I think one element where it is a little exaggerated at this point in time is the disconnect that you've seen between global investors and domestic investors, right? Which has lent a certain amount of balance or sanity or just a leveling at the market level. I think what this highlights in a very sharp manner is the fact that foreigners have been quite negative on the market for reasons of not necessarily India, but of markets in general, whereas domestics have been very, very positive. So I think that the dissonance or the disconnect in terms of ownership with some of these stocks is what is causing undue pain at this point in time. I think that's why it's a little exaggerated. That's why you are seeing, to some extent, absolute losses. But as you said, I think these businesses are doing fine. Their structural positioning is actually fine in terms of them being market leaders. So the rub-off that you're seeing is, you mightn't call it normalization, but in the grander scheme of things, it is a certain amount of normalization because you've seen reasonable returns with them over even a 3-year, 5-year period. And the multiples are still reasonable. So I think it's just, it's compounded a little bit by the holding pattern and the dissonance between the domestic outlook and the offshore outlook, right? But I don't think these businesses have necessarily changed fundamentally. I think what people, what invariably happens with markets is, the bullishness follows what's happening with stocks, right? And it tends to sometimes leave behind or kind of overlook what is happening in the broader environment. And the broader environment is that demand is soft. There is inflation that is non-demand led. There is a global macro that is, in an India context, turning adverse. You do have, from an FX perspective, you have a fiscal current account deficit that is widening. So, you take all of that into account. The stock outlook in India in general has been more sanguine than has been the economic outlook. And because of this distortion in ownership, you're seeing just a certain amount of pressure on a bunch of stocks. So, you can call it, I suspect you defined it more succinctly when you said, blue chip fatigue. But I think there's another perspective of looking at it. And this is the chain of events why you're seeing such developments.
Okay, so the blue chip fatigue, according to you, could also be exaggerated. And like you said, never say never. But that last time you were here, what you said very clearly was that you'll stick to your Nifty target of 18,000 for the year end. And this is a year where you have to look at themes in the medium term, not too short, not too long. That time you were looking at tech and financials. We've seen what's happened with tech and financials the last couple of sessions. What is your new medium-term thinking at the moment?
At some level, simply because we've been cautious at the market level, right? We obviously, over the short term, neither has tech nor have the financials tended to play out. But given the pain that they have already taken, I'd actually still stay with them, right? Again, given that we don't have exaggerated upsides in terms of what we can expect by the end of the year. And the reason I say that is that I think broadly there is a challenge with demand in economies and in the Indian economy, right? I suspect that these sectors are much more defensive or much less vulnerable to demand pains. I mean, even if you see the IT results, right, poorly as the market has reacted to them, demand has not been an issue, right? Well, there have been lots of questions on demand. Demand has not been an issue. It's a supply side thing. And if you were to have a problem, you'd rather have a supply side problem than a demand side problem, right? And I think to that extent, tech might remain soft for a little bit, but I think there is a certain element of comfort in that demand remains very strong, right? On the financials, again, I think there's been a little bit of a pricing and a margin issue to the extent that the market was maybe too optimistic, but you're beginning to see a certain amount of demand come back, firstly. And secondly, it is coming, it's the larger banks which are tending to capture it, right? So, poor as the last month would appear, and the last week or so would appear for some of these stocks and sectors, I'd probably still stay there, given that I think as a market, you've just got to be a little bit cautious. I think the underappreciated risk is on the demand side. The real risk is on the supply side, which you're already seeing in costs and pricing and in inflation, and the likely challenge that monetary policy will face progressively.
Aditya, favorite question to ask all experts nowadays is whether you would now buy HDFC Bank, given the massive fall that they've had.
Yeah, we would.
We would. Right away.
Yep.
You'll buy both. You'll buy both or you'll buy one?
Sorry? No, we'd buy both. I mean, in many senses now,
or
because you have a set
one.
major ratio, they'll go hand in hand.
No, but let's look.
They'll go hand in hand.
No, but let's look at it from a medium-term perspective. The return ratios, which is what analysts and markets look at, return on capital and return on equity, for HDFC Bank comes down. For HDFC Limited expands.
And Nico, if I might just excuse myself on this one, we are a little, we have some restrictions on the stock, so I won't be able to delve deeply into it going beyond our recommendation.
Understand. Okay.
Otherwise, I'd love to do it when we are freer to do so.
Okay. So let's understand a concept which, in a sense, or not a thought which you have advocated for years now. Pre-COVID, the huge blue book which is still on my table, importance of ESG, and that trade worked out like a charm. But suddenly markets are saying, all right, ESG is important, companies are getting more conscious, but we will not differentiate. ITC is bouncing back, Coal India is bouncing back, NTPC is bouncing back. These were the so-called, literally, if I may use the word, ugly ducklings. They become the swans now. Why are markets closing the eyes towards these companies which have ESG issues?
So I think what has happened is, I think there are two elements to it, right? Has the ESG trend unwound, right? Either in terms of how businesses are looking at it, or in terms of how markets are looking at it? My simple answer is no. The shift or the trend or the focus that you saw on ESG on a continuum will actually continue. I don't think there will be any material change. So that's one element. So ESG will matter whether it is valuing up some businesses or relatively valuing down other businesses. So I think that's one element. The second is what happens in the interim when either you have economic or market environments that are a little dicey or unpredictable, which is what you are getting at this point in time, or that there has been huge outperformance or underperformance because of ESG in some of these stocks, right? I think the latter issue is when you've had these huge swings or maybe just an over extrapolation of the impact or the influence, then you will tend to see some of these rebalances that are happening either on the upside or on the downside. But I think as things settle, I think you will get back to trend line in terms of ESG being important. Now, again, there's going to be potentially a little bit of a swing away from what had possibly become at one stage, which is ESG becoming binary, right? Which is if you're great on ESG, you're up there. If you're not, then forget it. I think that binary element will tend to disappear, but I think the secular trend toward it being a more important part of how the markets value you and a more important part of how you actually build and grow your business, I think that will actually tend to continue. And the third point that I would add at this point in time is that because of the market's focus on this and maybe excessive at points in time, I think underlying most businesses are doing the right thing or doing the better thing and actually improving their businesses from an ESG element. And I think that overall is a big positive for equities in general, right? More so for some companies and less so for others. But I think, what has also happened is that the extreme gap that had potentially happened at one point in time, that might narrow a little bit. So that's a long answer, but bottom line, I don't think it's going away. Maybe it had got a little extreme at a point in time, but I think that trend will actually continue. Maybe we can talk about it as the ESG fatigue in line with your blue chip fatigue. But it's much earlier in the cycle than in the blue chip cycle.
But Aditya, it's quite puzzling. It's quite puzzling when I see funds who are saying, look, I will not buy ITC, but I will buy an USL. I will not buy SBI, I will not buy NTPC, but I would buy Tata Power. And I'm not getting into individuals of funds, we both know the fund managers here, but it amazes me when just because it's part of your portfolio, fund managers end up buying these stocks.
I think maybe the binaries that existed at the market level and at individual fund levels, right? I think that will start switching to a spectrum. Okay, and I think that is the difference. Maybe it had become too binary, the whole ESG element, right? But will it be a spectrum or not? That we will buy, that someone's in red, someone's in green, but the bulk of them will be somewhere in the middle. And I think that's how it will tend to happen. It will probably not remain in binaries. The odd stock might fall into a binary, but otherwise it will tend to be a spectrum, right? And it's to be fair to fund managers, right? They also have to follow a process, right? Now you've got a slot, you give scores, you give exclusion lists, and you do other things. But sometimes looking from the outside, it would appear that there's no method in picking a stock or excluding a stock. There is a certain method, but I do believe the binary element of it in and out will change to how much and how much of an emphasis do we lay on ESG and other parameters in our investment decision. So I'd actually be fairly supportive of fund managers, even though the outside might call them out in terms of what should be in a portfolio or outside of it.
Last year was all about going green, ESG, the opportunity being too expensive, and 2022 we started to see that unwind. Look at the ITCs, Coal India, NTPCs. Aditya Narain, the other theme that's playing out, the at-home stocks in the United States. Look what happened overnight with Netflix, lost 2 lakh subscribers, stock crashed 26%. How are you folks looking at the unlock theme and the at-home stocks?
So, obviously the Netflix market response, though I think it was after market, so maybe it's at the end of the day, it might not be as extreme. I think that is quite honestly quite an extreme response. I'd say 2 things. I think we've seen this with other global stocks. Even Zoom, I believe it has come back to its pre-COVID levels. So to some extent at this point in time, it's just ended up being a lump of earnings for a 2-year period, and then it's business as usual. I suspect for India, there will be similar elements of it, that there will be a lot of excitement around the unwind, and then some tapering off. But I do believe that in India's case, given where you are in the developmental cycle and the unlock trades being more basics like, home decor and the movie space, I would tend to believe that you will end up having elements of this unlock trade. People get very excited and then there's a moderation. But structurally, I think because there's been underlying consolidation that's happened with a lot of these businesses, and growth rates for the leaders will actually pick up a little bit. So there will be elements of this unlock trade that will replicate itself or play itself out in some way with the Indian businesses in this space. But I don't think it's going to be as dramatic as it has been with the case of Netflix or some of the others. And I do think you will see as far as the leaders are concerned, growth levels that just might be at a more elevated level. than was the case pre-COVID for them.
Aditya, I know Nikunjan, you were more interested in Flipkart, Amazon, etc., but it's more Trent and Aditya Birla fashions for me. Just wondering, especially in light of now Reliance brands going on and picking up stake in all these mega designers, and I don't think they've left any of the top league at least. This is turning out to be a really interesting space. I mean, as limited a listed space as it may be, and as high the PE multiples may be, seems like the going is going to be good for some while to come.
Yeah, so I think, to some extent, you could also argue this is part of the, there could be an element of the unlock trade that is accelerating and potentially exaggerating things at this point in time. But I do believe, I think you've got to be a little watchful. I think the difference between India and globally is that here you're getting a certain amount of consolidation. You're seeing it in real estate also, where real estate demand looks very, very good for the guys that, you and I and the markets follow. But if you were to look at the aggregate, the growth is not that significant at the market growth level. And it is concentrated, both amongst developers and in geographies. I suspect you could have something that's somewhat similar for, the fashion wear and other categories where you're getting a certain consolidation. You're getting segments that actually do very well. But at the end of the day, will the entire market, do as well? I'm not so sure. The fact that there remains in these spaces an easy consolidation, I think is what is going to play to these stocks. So to cut a long story short, I think these stocks are in a good place. These businesses are in a better place. But there will be some elements of this unlock, which you need to be a little watchful about also.
Right. Okay, Aditya, great talking to you, and we'll catch you again soon, and maybe offline we can discuss more and more of the blue chip fatigue stocks or ESG fatigue or not.